I lost everything in 47 days. Not because I couldn't read charts, not because I didn't understand technical analysis. I lost everything because I thought being aggressive meant being smart. And that single belief cost me more than money. It cost me sleep, relationships, and nearly my will to keep going. But what came after taught me the only lesson in trading that actually matters. You know what's interesting? We celebrate the wrong traders. We make heroes out of the ones who bet big and got lucky once. We ignore the thousands who bet big and disappeared. We worship the highlight reel and forget that for every massive win we see posted online, there are hundreds of blown accounts we never hear about. The trading world has this backwards, and it's destroying people. Let me tell you about two traders who started on the exact same day with the exact same amount of money. Both had $25,000. Both studied the same materials, watched the same educational content, practiced on the same simulators. Both were actually pretty good at spotting opportunities. On paper, they were identical. 6 months later, one had $31,000 and slept fine every night. The other had $8,400 left and was having panic attacks. Same skill level, same market, same opportunities. The only difference was how much they risked per trade. The first guy risked 1.5% per trade. Boring, right? His friends called it scared money. Said he'd never get anywhere trading that small. The second guy risked 5% per trade because he wanted results fast. He was tired of his job and saw trading as his escape route. He needed bigger wins to make it worthwhile. One bad month almost ended him completely. He stopped sleeping properly. His girlfriend noticed he was always on edge, constantly checking his phone at dinner, at movies, even at family gatherings. Trading consumed his entire existence, and not in a productive way. Here's what nobody tells you about aggressive trading. The math looks appealing at first. Risk 10% per trade, catch a big winner, and suddenly you've doubled your account. It sounds logical. More risk, more reward. That's how it works everywhere else in life, right? Except trading isn't like anything else in life. In trading, more risk just means you die faster. When you risk big amounts, let's say 10% per trade, 5 losses in a row cuts your account nearly in half. You go from 20,000 to about 11,000. Now you're sitting there staring at that number, and something breaks inside you. You're not thinking about making money anymore. You're not looking for good opportunities. Your entire focus shifts to getting back to where you started. And that's a completely different mental game, with completely different emotions, driving every decision. The trader risking 1% per trade after 5 losses is down 5%. They're annoyed, maybe frustrated, but they're not in survival mode. They're still playing offense, still hunting for the next good setup. One trader is trying not to drown. The other is still swimming toward the finish line. That's everything. And here's where it gets worse. To recover from a 50% loss, you need a 100% gain. You have to double what's left just to break even. The trader who lost 5% needs a 5% gain to recover. One needs a miracle. The other needs a decent week. This is why aggressive trading is a trap that tightens the more you struggle. There was a guy in a trading community I was part of. Started with $50,000. Actually talented at reading price action. Made smart decisions for about 2 months. Got his account up to 71,000. Then he started talking about how he'd figured it out. Started posting his daily profit and loss. Started risking 8% per trade because when you know, he said. Then he hit 5 losses in a row. Just normal trading. It happens to everyone. His account dropped to 45,000. Watch what happens next because this is where most traders lose everything. He panicked. Started posting about needing to make it back. Started risking 15% per trade to recover faster. Said he couldn't afford to grind it back slowly. 3 more losses. Account at 26,000. Now he's completely desperate. Started taking trades that didn't match his strategy. Started risking 25% per trade on pure emotion, pure hope, pure fear. 6 weeks after his peak of 71,000, his account was under $3,000. He posted one final message about how trading was rigged against regular people, then vanished. I think about him because he was genuinely skilled. His analysis was solid. His timing was good. But none of that mattered once he entered what I call the death spiral. Big position sizing leads to big losses, which leads to bigger position sizing trying to recover, which leads to catastrophic losses. It's a pattern I've watched destroy trader after trader. Safe traders never enter this spiral because they never take that first devastating hit that starts the panic cycle. Jesse Livermore is famous in trading history. In 1929, he shorted the market right before the crash and made the equivalent of about $1.5 billion in today's money. He became a legend. People wrote books about him. Other traders studied everything he did. He was the guy who figured it out. 5 years later, he declared bankruptcy. From billionaire to broke in 5 years. How? He got sloppy with position sizing. Started taking massive positions when he felt certain. Confused a winning streak with being invincible. Started thinking the rules didn't apply to him anymore. Before he died, he wrote something haunting. He said his life had been a failure. The man who once controlled enough capital to move entire markets died broke and broken because he couldn't stop betting too big. Here's what happens inside your brain when you trade aggressively. You risk big and win. Your brain floods with dopamine, feels incredible. You feel like a genius. You want that feeling again, so next trade you go even bigger. Why wouldn't you? You just proved you can do it, then you lose. And losing hurts way more than winning feels good. This isn't just a saying, it's actual neuroscience. The psychological pain of losing is roughly twice as strong as the pleasure of an equivalent win. So now you're in a hole and your brain is screaming at you to win it back immediately. You can't think clearly. You can't be patient. You just need to get back to even. So you size up even more, trying to recover in one or two trades. This is called revenge trading, and it's how most accounts actually die. Not from bad strategy, not from poor analysis, from emotional decisions driven by position sizes that are too large. Safe trading removes you from this entire emotional nightmare. When you're only risking 1% per trade, your emotional response is muted. A loss is annoying, not devastating. You're not spiraling. A win is nice, but you're not getting high on it and making stupid decisions on the next trade. You stay clear-headed. You stay rational. And in trading, rationality is literally everything. March 2020, the virus hits and markets absolutely lose their minds. Chaos everywhere. Stocks moving 20, 30, sometimes 40% in a single day. Circuit breakers triggering. The fear index spiking to levels not seen since 2008. If you were risking 10% of your account per trade and got caught on the wrong side of one of those moves, you could lose 30 or 40% of your entire account in hours. Not just your position, your whole account. Because stops were getting blown through, slippage was insane, and volatility was eating people alive. Traders risking 1% per trade took hits too. But a 30% move against a 1% position is a 3% account hit. Painful but survivable. Here's the brutal part. That crash only lasted about a month, maybe 6 weeks. Then markets started recovering, and they recovered fast. If you survived that initial drop, the opportunities on the way back up were incredible. Safe traders survived and made fortunes on the recovery. Some had their best months ever. Aggressive traders were already out, sitting on the sidelines with blown accounts, watching everyone else profit, trying to figure out how to save enough money to start over. Volatility doesn't care how confident you are or how good your analysis is. It just eats aggressive position sizes for breakfast. You want to know what actual professional traders risk per trade. The ones managing millions and billions. Most risk between 0.5% and 2% per position. Some successful hedge funds go as low as 0.25% on individual positions. These are people with entire research teams, advanced algorithms, real-time data feeds, decades of experience, and they're playing it safe. Why? Because they learn something retail traders refuse to accept. Staying in the game is more important than any single trade. Survival is the prerequisite for success. There was this guy, Marcus. Engineer, analytical, everything you'd want in a trader. Started with $75,000, his entire savings. Because he was analytical, he thought he could optimize returns by risking more per trade. First 6 months, he risked 7% per trade, made some money, felt great, got his account to 91,000, started thinking about quitting his job, started telling his wife this might be it. Then reality hit. One bad 3 weeks. Account dropped to 54,000. He was devastated. Went over every trade trying to figure out what went wrong. Truth was his strategy was fine. His analysis was solid. His execution was good. His sizing was the problem. He took a month off, didn't look at charts, needed to reset mentally. When he came back, he was different, started risking 1.5% per trade. It felt slow. It felt boring. Nobody was impressed with his returns. But he was consistent. 3 years later, his account is at $286,000. He quit his engineering job, trades for a living now, has his mornings free, coaches his kids' soccer team, actually has a life. He told me something unforgettable. He said he wished he'd learned this lesson before it cost him $21,000 and a month of his life in pure stress. The strategy was never the problem. His ego was the problem. When you take a massive loss, you're not just losing money, you're losing time. And time is the one resource you absolutely cannot buy back. Say you lose half your account. Even if you're genuinely good at trading, getting back to where you started takes years. Literal years of your life just trying to reach break even. Lose 10%, you recover in months. But there's an even deeper cost. Every month you spend recovering from a massive loss is a month you're not compounding. A month your money isn't working for you. A month of missed opportunities. If you blow up your account, and it takes 2 years to get back to where you started, you didn't just lose 2 years of time. You lost 2 years of compound growth, 2 years of market opportunities, 2 years where you could have been building real wealth. Let's get practical. You start with $10,000. You're decent at trading. Nothing special, just consistent. You risk 1% per trade. You're slowly growing. Some months up 3%, some months up 8%, some months barely anything, some months down a bit, but over time trending upward. Year 1, account grows to maybe 14,000, not life-changing. Year 2, 20,000, starting to feel real. Year 3, 30,000, now you're paying attention. Year 4, 47,000, your friends are asking questions. Year 5, 75,000 or more. These aren't lottery numbers, but this is real wealth being built, and it's sustainable. You're not stressed. You're not losing sleep. You're just consistent. Run the same scenario with aggressive trading. Most don't make it to year 2. They blow up in year 1 or early year 2. The ones who make it longer are usually rebuilding from blown accounts, learning the same painful lessons repeatedly. By year 3 or 4, they're exhausted, burned out, convinced it doesn't work. Meanwhile, the safe trader just keeps compounding. While everyone else is starting over, they're building real, lasting wealth. Every time you blow up and have to rebuild, you miss the best opportunities in the market. The recovery after the crash, the boom that followed, whatever the next big thing will be. Those moments happen whether you're in the market or not. But you only profit if you're actually in the game with capital. When you're sitting on the sidelines broke, trying to save up money to fund another account, those opportunities pass you by. Warren Buffett has 2 rules. Rule 1, never lose money. Rule 2, never forget Rule 1. Sounds simple, almost too simple. But look at his track record. He's been investing for over 70 years. His worst drawdown was about 50% during 2008 when the entire global financial system was collapsing. Most years his drawdowns are small, single digits. He's not trying to hit home runs every quarter. He's focused on not striking out. And because he never strikes out, he gets to keep compounding year after year, decade after decade. Same principle in trading. The traders who become wealthy aren't the ones swinging for the fences. They're the ones who stayed in the game long enough for compound growth to work. And compound growth only works when you're not constantly digging yourself out of massive holes. Here's what really matters. When you know no single trade can hurt you, everything about your trading improves. You're not hoping. You're not praying. You're not staring at charts, sweating, moving your stop loss because you can't afford to take the hit. You just execute your strategy, take the trade, manage it according to plan, move on. This psychological freedom improves every aspect of your trading. Your entries are cleaner because you're not hesitating. Your exits are sharper because you're not emotionally attached. You follow your rules because there's no reason not to. Aggressive traders can't do this. They're too emotionally invested in every single trade. When you've got 10% of your account on the line, you can't be objective. You start seeing what you want to see. You move your stop loss because you need this trade to work. You exit winners early because you need the relief. Their strategy might be fine, but their psychology is destroyed by their position sizing. This psychological edge compounds over time. Every trade you execute perfectly builds confidence. Every time you follow your rules exactly, it gets easier next time. You're building a track record of discipline. You're proving to yourself that you can be trusted. The aggressive trader is building a track record of panic, hope, and regret. Even when they win, they're reinforcing bad habits. Over months and years, the psychological gap between these traders becomes massive. One is calm, confident, consistent. The other is anxious, impulsive, erratic. Same markets, same opportunities, completely different experiences. The lesson isn't about being scared. It's about being smart enough to stay in the game. It's about understanding that trading is a marathon, not a sprint. It's about respecting the fact that survival isn't just important, it's everything. Because you can have the best strategy in the world, the sharpest analysis, the perfect timing. But if you're not around to execute it, none of that matters. The market will always be here tomorrow. The question is, will you?